have more on the reaction in this Fed panel tonight with Kyle Bazzy, president of Benzinga in Southfield, Michigan, and Michael Levas, founder and senior managing principal at Olympia Group of the investment management companies. Gentlemen, to both of you, thank you very much. Let me start with this. Are you as happy as the markets are, Michael?
Absolutely. I think it was a great rally this afternoon. I was pleasantly surprised to see the turnaround. We had a slight negative reaction, but towards the end of the day, it was just a great move on the upside.
Kyle, explain to our viewers why the average person who's sitting there at home watching this, who might have a 401k plan and might have a couple credit cards, why should they care?
That's a great question, and obviously we see the S&P and the Dow at all-time highs, and the market acting very favorably to the news today that we're going to start tapering. This is like the T in tapering, as the bond buying is still going at $75 billion per month. The average person is looking at this though, and short-term interest rates will stay low, which means borrowing from the banks will also remain low. So looking for a mortgage or credit cards or any type of loan that they're trying to get, they're able to see into the foreseeable future, and obviously with that being extended, that they'll be able to do that at cheap rates, or almost historically cheap rates for the near future.
I mean, that's a good point, gentlemen. Rates are going to be low beyond the 6.5 unemployment target that had originally been discussed. It's not it's not a hard target, but it was something that we were all kind of looking towards that. And the fact that they're going to basically not look over it, but let that be as it is and keep rates low and commit to that, that's going to benefit a lot of people, people who own homes, people who have credit cards, people who have student loans. Michael, how big of a factor is that going to be for the economy over the next year?
I think it's going to be a very, very big factor. I think it's going to continue the stimulus. Obviously, the Fed's reaction today is that they're seeing things getting better. And obviously, that's going to help promote exactly what you said: home buying, refinancings, credit cards, more activity in the consumer markets overall, without question.
Kyle, Santa Claus came early for the markets, but if I'm a trader in Europe or Asia, how is this likely going to affect them?
Stronger dollar. You saw gold with a nice little rise there. Commodities are going to get a boost, and with a stronger dollar, you're going to see foreign investment feeling more comfortable to invest in U.S.-backed securities. And I think that's a key here for traders. I know a lot of traders at Benzinga were looking at the moves, and they were happy to see that short-term interest rates will stay low. You're going to see, like I said, a lot more economic stability, and I think that's what the key here is for traders and investors.
I hope you guys don't mind, but I'm going to throw some cold water on this celebration. We had a guest on here yesterday that talked about the fact that a lot of senior citizens who had a lot of money in savings at banks, money markets, bonds, they're not getting much interest rate. The markets are happy, but for those who are big savers, aren't they negatively impacted by all this, Michael?
I think if they're investing in bonds and they're investing in corporates and preferreds and those type of asset classes, I think they can do extremely, extremely well. Now, if they're just in passbook savings and CDs, excluding jumbo CDs and negotiated CDs, then I mean, obviously they're not doing as well as the corporate bond investor. And some of the municipal yields, for instance, have been very good, and also in high yield and in emerging market debt as well. So if they are investing in those type of asset classes, they will continue to see a good amount of income coming into them.
All right, I'm going to ask you about predictions for 2014. We're a couple weeks away, but is it looking as good as we feel, I guess, going into December? Should we look at 2014 as, I should just tell everyone to jump into the markets, Kyle?
Yeah, 2014, and I think this is going to be the really big year coming out of the recovery as we're looking at it. But we got to remember that we're still printing $75 billion each and every month, and we need to stop doing that to get to a more normalized economy. We got to allow the economy to get back on its feet by itself. Otherwise, we'll see inflation without wage inflation, and it's going to negatively impact the average person.
Well,
but
that's
for 2014,
that is a great point. Why have we not seen really any inflation in the United States. I'm sure some people would argue that they have seen inflation, but statistically speaking, we haven't seen the inflation that you would expect by having rates so low for so long, Kyle.
I was just having this conversation the other day with another local entrepreneur, and we are not looking when we're hiring, and we are hiring, that we're not having price wars. We're not getting pushback on the salaries that we're looking to pay people. And that's because there's no wage inflation. A job for somebody is still not a given in this economy. And without wage inflation, you're not going to see the inflation rates rise.
Okay, Michael, I want to get you in on this conversation on the economy. We don't have wage inflation, but you and I know supply and demand matters. As more and more people ultimately get back to work, there's less and less people out there to work. Companies will have to pay more ultimately, won't they?
Absolutely. And Phil, don't forget, as I've mentioned many times, the pensions here in the United States have to continue to pay their pensioners 7 to 7.5%. So that's going to continue to drive these markets higher because the amount and the rate of the pensions buying U.S. corporate debt is still continuing at an incredible rate. I mean, December alone, we saw a tremendous increase in the amount of bond buying. So this will also help the overall economy without question as we see the market going higher.
Michael, I'm going to take an unscientific poll and ask you, if I had $1,000 today, how much of that would you put in the stock market right now?
I would be, as I always am, I would probably be I would diversify my portfolio, put 70% in equities, and take 30% and diversify amongst different asset classes.
Kyle, last word, you the same?
Yeah, I'm looking at stocks, you know, even though the PE historically is still pretty low, with our bond buying, I'm looking at, you know, less than 50% in equities right now, just because I think that we're overvalued.
I just get nervous when everyone is so excited. Kyle Bazzy, President, Benzinga, Michael Levas, Founder, Senior Managing Principal, Olympian Group from Florida. Thank you very much to both of you. Have a great evening.
Thanks, Phil.